Hugues SAILLARD, you are from SocGen, but Société Générale, you are based in Brussels, and what is important is how to be practical in that. We all have the same objective, to finance the economy, the real economy. We have now this single rule book. How do we leverage that single rule book in the interest of this of the real economy? Is it feasible? Is there some coherence or incoherence to do that? And what should be the priority if there is some problems to solve those problems?
Thank you very much, Edouard. Yeah, allow me to come back a bit on what we've just mentioned. I mean, just a quick assessment of what we've just experienced in the last 5 years, 7 years of crisis. So, I mean, as has been said, I think we can all agree that the G20 commitments to reform the financial sector, sorry, have been delivered. And they've provided the groundwork for the banking union, which of course will be a cornerstone to strengthen the EU economies. Banks have rebuilt their balance sheets to be compliant with Basel III. As has just been mentioned, banks are implementing the resolution framework, including bail-in, which is the real key to end this debate around too big to fail. But so that has been achieved. However, after 7 years, we still have very slow growth or no growth at all. And that remains a reality in many European economies. Just to give some quick ideas about that, I mean, we only expect a return to 2007 levels of GDP in 2015, so next year. I'm going to give maybe some figures as well of regarding the challenges we face in Europe. I'm going to use Italy. I'm sorry for our Italian colleague, but I think these figures could apply elsewhere. I mean, if you look at the situation, for example, in Italy, I mean, investment has shrunk by 27% compared to 1996 levels. Industrial production has shrunk by 24% since 1986 levels. So I think, I mean, this is Italy, and again, I think I'm not at all stigmatizing the situation there. I think we all have, but these were, yeah, figures I had this morning. So, I mean, it's just a way of conveying the reality that we are in a challenging, slow growth or no growth economic situation, as we all know. So, in this context, I think banks and our bank remains, I mean, fully committed to funding the Eurozone economy. Credit to non-financial institutions has remained stable in France or Germany, and the decrease has stabilized in peripheric economies this year. I mean, household credits continue to grow. We have 3.6% of growth in France, 1.4% in Germany, and bank deposits have increased throughout the Eurozone. So, to come back to the question, what is our expectation as a bank? I think our expectation is that regulation should achieve to encourage the development of strong European banks that are able to accompany their clients in their international development, which is in fact a matter as well of sovereignty for the European Union. I mean, we need, for the Eurozone, we need strong banks. We need banks that can provide the services that our clients request. And our message is therefore quite simple. If we want to support the growth agenda, which we fully are committed to support, I think the challenge we face is to match better align the regulatory framework with the growth expectations we have. I think we've regulated, you mentioned 41 directives and regulations. We've achieved a great deal in the past 5 years to stabilize the situation and start on a fresh start, as you mentioned. But now we have to look back and make sure this falls into place. So just on that last topic, and I'll be brief, I think, I mean, this idea that we have to align expectations with the rules that we have, I'll just take 3 examples of some cases where we see obvious contradictions between, on the one hand, the growth objective and the underlying rule. So, for example, if we take disintermediation, financial markets, I think we all know very well that the regulatory reforms encourage greater reliance on capital markets as a source of funding. We know that in Europe there is an over-reliance on bank credit, which is exactly the opposite situation in the US. So we fully support this substitution, I mean this greater reliance on capital markets. And we recognize that much has been achieved in terms of transparency, security for investors in pieces of legislation such as EMIR or MIFID. However, at the same time, at the very same time, we are facing debates in the European Union on the introduction of a financial transaction tax, for example. A financial transaction tax, which in the project which was delivered by the European Commission, simply recognizes a decrease of 70% in the volumes of derivatives. Derivatives are not, it's not a bad word, it's a very useful tool for hedging corporate risks and used very commonly as such. So there's a clear contradiction. If you can't ask banks to accompany their clients, because SMEs and need good and functioning banks to tap the capital markets, so you can't ask the banks to be involved in that agenda if at the same time you recognize that they are going to be completely evicted from the EU 11 member state zone where the financial transaction tax is considered. I think the same can apply to this very controversial piece of legislation regarding structural reform of banks, the so-called Liikanen project, which would force banks, major EU banks, to break up and shift their market activities into new separate legal entities, which are not guaranteed by the group, that don't have any track record for rating agencies, and which will simply not be in a position to deliver funding and financial market services at a competitive level with their US, for example, counterparts, which have remained and will remain universal banks. There is no talk in the US in the Volcker rule of actually breaking up the banks. The banks are legally broken up, but they're actually guaranteed, and that is a stable and robust model. So, for example, there you have in the disintermediation field, you have these two examples. If you took a long-term financing, and I'll be quick, long-term financing. There was a green paper on how to foster long-term financing. I think we all recognize that we need long-term financing for the many points we have to the energy transition. I mean, the energy projects we have, there is need and other domains for long-term financing. At the same time, there is in the Basel III proposal the request to introduce a net stable funding ratio, a prudential ratio, which has the exact effect of limiting banks' capacity to transform short-term deposits into long-term loans, which is the basis of the banking business. So there again, I think it's just a way of underlining the fact that we have contradicting signals. And maybe a last one will be securitization. I think this morning you mentioned there was a panel which went on that field, securitization, how to re-dynamize the securitization market. We, of course, share that objective. There again, the prudential calibrations are very punitive as we speak. and the treatment does not reflect the underlying risk. I think, just to take an example, if you take asset-backed securities, which is a very common product, if you take a look at the default rates in the US and the EU, you compare them, you have a 17.1% default rate in the US and you have a 1.4% default rate in Europe. And then again, the debate at the Basel level does not reflect these differing realities. I think we need to have a securitization, prudential treatment that takes better account of the underlying economic reality. So there are a few of the points I wanted to touch upon.